Good evening, everybody. Please stand up as our motto will be played.
Yaesha Supteshu Jagrati Yaesha Supteshu Jagrati Kamam 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 Kamusho Pursho Nirvimana Nirvimana Tadeva Shukram Brahma Brahma Tadeva Mritamucchate Tasmin Lokaha Shataha Sarve Tanunam Sarvitaschanamyakitaschan Etat Dvaita Etat Dvaita Etat Dvaita Etat Dvaita Etat Dvaita Etat Dvaita.
Thank you. I would request our past president, C. Subodh Agarwal ji, please come up on the dais and take your chair. Please give a big round of applause for welcoming C. Subodh Agarwal ji. So while everybody is busy in the calculations of currency, what will be happening with the currency, rupees 500, rupees 1000, but we all are here to hear from Subodh Agarwal ji about AS11, INT AS11. This is with respect to constructions contracts. And thereafter we will have the second speaker, CA Arif Ahmed. He will speak in INT AS18 for revenue. So in front of Subodh ji, nothing to say because he is such a great person. Everybody knows him very well, but still I am giving you a formal introduction of C. Subodh Kumar Agarwal ji. He is a former president of ICAI in the year 2013-14 and was the president of South Asian Federation of Accounts for the year 2014. Before being elevated to the Central Council of ICAI and reaching the most coveted post of president, ICAI he was the chairman of DIRC of ICAI for the year 2006 up to 2007, having passionately represented Indian accounting professions on the international front. He has been the member of various committees of ICAI. He had secured 10th rank in CA final examinations held in November 1988. He is an ardent proponent of Brand Indian CA and is very active in the accounting profession. He specializes in the area of internal as well as statutory audit and has also been provided consultancy services in the field of accountancy and auditing, particularly matters relating to Indian and international auditing and accounting standard, corporate governance, and business restructuring. Hailing from Kolkata, India, he has specialization in the area of internal and statutory audit of private as well as public sector entities. He is a prolific speaker and has addressed various seminars and conferences on various issues of professional interest. Whenever we are thinking about the speaker, the first name comes in our mind, that is only C. Subodh Agarwal ji, not only in Calcutta but everywhere in India. We have gone international conference also in Hyderabad and he was also there as a speaker. So for welcoming C. Subodh Agarwal, I would request C. Siv Kebia, please come up on the dais and offer a flower bouquet for welcoming our own past president. I'm handing over mic to the CS Bochi because you all are eager to hear from him. Over to you, sir.
Thank you, Sonu. Good evening, everybody. Today the topic is that is given to me is construction contract. India's 11 India's 11. You have been having this class, 3 hours class since last 3-4 days. So I can presume that if you are a fresher, you have gathered a lot of knowledge on India's. You have gathered a lot of knowledge on the India, so you are not fresh now. But still, I would like to know how many of you have already had experience in implementation of India, because as all of us know, the first phase of India's implementation is over. June 2016 quarter for the listed company was first India's for India. If not, how many are going to have their hand tried in the second phase? That is from 1st April 2007, when the second phase is going to be implemented. No hand is being raised. Probably all of you or all of us, including me, we are going to try our hand, or are looking at that we will get opportunity at least in the second phase, not if not in the first phase. That's a good, because as a professional, we know that we need to sharpen our knowledge on a daily basis. India being very new subject, new for we Indian Chartered Accountant, not for those who are in big four, but yes for other than big four, because we didn't get opportunity to have IFRS compliant accounts audited or accounting done. But as we know, every day new things are coming in, be it IFC or be it India's, or for that matter in other areas also. India's the basic change that has come from our existing accounting standard, you must have been told, is fair valuation. Number 2, substance over form. Number 3, principle-based accounting. Number 4, more and more use of judgment and estimates. And number 5, more and more disclosure. Be it in the name of the transparency, disclosures, and sometimes we will find, if you have gone through the India's compliant accounts, you must have seen that the disclosure pages has surpassed the number of the accounts and profit and loss and balance sheet pages also. So in bigger company or where the consolidations are there, you will find that the financial statement may contain 100 to 200 pages also, and sometimes we talk, it will be difficult for smaller persons or smaller entity to evaluate and look at what information he is looking at, where the information he will get in. And in this context, it becomes very important, at least for chartered accountant, to have the knowledge of India's construction contract. We know that even before March 2016, we didn't have India's 11. We had India's 115. 2 accounting standard, India's merged in 1. But then the institute, Dinakas, they decided that it's too early. Across globe also, probably none of the country has early adopted India's 11, India's 115, for that matter IFRS 15. None of the country has adopted. And we got representation from industry that there are many implementation issues in IFRS 15, that is India's 115. Then at the wisdom of its wisdom, the issue and occurs, that means for Ministry of Corporate Affairs, they also thought, let us defer it. Maybe from 2017 or 2018, we will find India's 115. But before that, India's 11 and India's 18. When the EIRC proposed, they had kept these two topics differently, but then they decided that no, both the topics should be in one day. Today, when I will deliberate, you will find that I will cross at many places where India's 18 will come. But I will not diverge, or I will not try to enter into India's 18. I'll just pass through that because the next speaker will be speaking on India's 18 also. In this particular standard, when I speak, you will encounter 3-4 more standards. India's 109, 32 and 107, that is financial instrument. Probably in all these standards, whenever you must have heard, these three standards will just come in or pip in and just try to say something. Somewhere some reference will be there. India's 37, that is contingencies, provisions, contingent asset and contingent liability. India's 1, it is applicable everywhere and anywhere, whichever standard it is there. These are 2, 3, and India's 18. And then India's 38 also, intangible asset. India's 16 is not that much applicable in this standard because this standard says that asset cannot be recognized. So India's 38 will be applicable, and impairment for 38, impairment will be of 36, India's 36, but for financial asset impairment, the applicability will be 109. Friends, with this short remarks, I'd like to proceed. Yes, I know that you all are ready to learn. You have already, whatever you have learned, you have already unlearned and you are ready to relearn this thing. So construction contract, we had accounting standard 7. Construction contract, it's the equivalent of accounting standard 7 with the India's flavor. India's flavor, we find that in India, the fair value, the financial assets, the intangible asset, everything is coming in. So what is construction contract talks about? So next. So technology is very good, but technology always disturbs us also. So this is the agenda for, I have divided my presentation in 2 parts. Part 1 is construction contract, and part 2 is, if you know, some of you know, in IFRS there was a IFRIC 12. IFRIC 12 talk about the service concession agreement. Today we know that in our country also, under public-private partnership, in a bigger way, all expressway has come up. I mean, 500 kilometer expressway and that expressway. So those all have come under IFRIC 12, that is service concession arrangement, and that has been made part of India's 11 as public-private partnership service concession arrangement. So I have made those in another part. After I finish construction contract continuously, you will find the deliberation on service concession agreement. In agenda is, I will go through introduction, combined and separate contract. When we will take the contract as combined and when we will take the contract as separate. Revenue, how to measure revenue, how to measure cost, and then recognition and measurement of cost and revenue. Estimate. If estimate is there, then automatically India's 8 will come into picture, which I will be talking on 17th of this month. Examples. Yes, friends, I have been told that, and I was directed by Nitesh that if you give more and more examples, probably it will be easier for members to be in touch. So I try to connect to all of you through examples. Disclosure. Disclosure I will be giving very much less time because I don't find that disclosure you can deliberate and you can go through the text also. And then in the last, service concession arrangement. Service concession arrangement will be giving at least 30 minutes to 45 minutes time. construction contract. We are talking about accounting. We are not talking about audit. Here, you all are sitting to be accountant. And later on, when you go for audit, then you can use your expertise as accountant to be the auditor of your company or wherever you are going that. Now the difficulty we find that in construction contract, generally the contract lasts more than 1 year. If it is completed in 1 year, no issue. Whatever expenses, whatever revenue and cost is there, it will be debited, profit and loss will be calculated, no hassle, no tension. But if lasts for more than one accounting year, then issues comes up. Then allocation of the revenue, allocation of the cost, that comes into picture. Then how to allocate the revenue? What is the method of allocating the revenue? If there is a loss, whether the entire loss as a prudent, we should charge to that year, or it should also be allocated on a different years. Accounting, this standard talks about accounting only in the books of the contractor, not in the books of the contracting, and allocation of the cost. Now, what is the definition of construction contract? Friends, my suggestion will be, here since I will be deliberating with various examples, it will be very, I'm sure that I will be able to deliver you what you are looking at. But once you go back to your house or your office, please go through the entire text. In text of the India, then it will be easier for you to grasp whatever you have heard today. So we will start with the definition of the construction contract. What is construction contract? As per the India's 11, it is a contract specifically negotiated. Negotiation means there should be written contract, there should be maybe writing, may not be in writing. But we know that in contract generally it is writing where terms and conditions are there. For the construction of an asset that are closely interrelated or interdependent. This interrelated, interdependent. If there are many assets, that is interrelated, interdependent, it becomes important whether we need to take it as one contract or we need to treat it as different contract. In terms of their design, technology, function, or their ultimate purpose or use. Example. What can be the example of construction contract? Road, dam, building, hospital, what else? Public utility services, building of the Institute of Chartered Accountants of India. So these are all, if the owner does not himself wants to construct, but wants to give to some contractor, but for that, there need to be an agreement. A contract need to be there where everything should be attached. Now, what can be the closely interrelated or interdependent? If this is one building, there is no need for closely interrelated or interdependent. The design is given. Technology function, technology whatever, RCC, RBC, whatever, they have already said. And the function of this building, they say that this is an academic institute, accordingly it has to be because the design will be given by the owner and it will be duly approved by the corporation. So there is no interrelated or interdependent. But if there is block of 4 5 things where one is lab, separately, one is a building, the other is a say school and colleges, then it becomes interrelated. And if there we need to look at whether the contract is one contract or it is a 5 contract, that will come later on. It also says that also contracts for rendering of services that are directly related to and for restoration of environment or restoration. Example, what can be? Like if the issue says this building need to be demolished and a new building need to come up. Like in Delhi, there is a proposal that our head office, they have acquired one more land, adjacent land, and they are now planning that the entire old building to be demolished and one new building to come up. If one building is to be demolished, that will become part of the, if it is one contract, part of the contract, then it will become part of the contract. Say a chemical plant, you are coming out with a chemical plant where it says that after 10 years, it needs to be restored. If it has been made part of the contract, then that restoration also become part of the contract. But there can be different contract also. Fine, this is one contract to build a chemical plant. And this restoration also I give you, but you get the contract differently or separate, then it will become two contracts. Now, the standard differentiate between two types of the construction contract. The construction contract can be of two types: fixed price contract, cost plus contract. All of us know what is fixed price and what is cost plus. Fixed, because our recognition and measurement will depend on fixed price and cost plus contract. That's why it's become very important. Fixed price contract is a contract in which the contractor agrees to fixed contract price. I take this building for construction, I am a contractor, at 15 crore rupees. That is a fixed price contract. But it may include escalation clause also. Suppose if the owner of this land or building is not supporting me, and instead of 24 months it is taking 36 months time, escalation clause may be there. So it may include escalation also. In fixed price contract also includes a contract for a fixed rate per unit of output. That's fine. Whatever your output is there, I will build a factory, and your output for 5 years per production unit, this much of I will charge. That also is covered in fixed price contract. The another is cost plus contract. In cost plus contract, as the terminology itself says, whatever will be my cost, their markup will be there, or some fixed price will be there. We know that KG12 basin, that Reliance Jamila is going on. But there, in the contract it is mentioned what cost will be taken, what cost will not be taken, and at what level of production or this thing. If the production level is, as we know in the costing, that normal level of production, the cost is taken. If it is abnormal, immediately that cost has to be taken out. Now, we talked about at a single contract, if it is a single contract. But there are situations when we will find that there are combined contract also. If there is a combining, or in single contract we find that there is a segment. One single contract can have a 5 contract. If you look at the contract, this thing. If it is a contract covers number of assets. If in one contract there is 5 assets, it says that it will be separate contract only if it will be taken as one contract. But it will be taken as separate contract only if separate proposals have been submitted and separate negotiations. If there is 5 assets in one contract, but 5 proposals have been submitted and 5 negotiations have been done, then it will be taken as a 5 separate contract. And cost and revenues can be identified. I don't know whether India 16 has been done. This is no. India 16, we know that for any asset, the miserable, probable, miserable, and identification. These are the 3 criteria. Then only we can identify and took the asset in the books. So cost and revenue can be identified. A group of contracts. There are different contracts, but it can be treated as one contract. A group of contracts can be treated as one combined contract if it is negotiated together, closely interrelated, performed concurrently. All the works are going on. I will give you an example of oil refinery. We know that multiple design, multiple technology, multiple assets are there. There may be many things going on. But if it is whole project is taken together and negotiated together, and the work is going on together, then it is a one contract. If additional contract is given, suppose I am doing this construction work. Later on, the owner says, fine, you need to add one more floor, or you need to add one more thing there. So if there is an additional contract, it says that it will be treated as one, but it can be treated as separate only if it is significantly different, number one. Number two, price negotiated without regard to original contract. So, contract, reading the contract, before we launch on accounting, we need to read the contract line by line, jot down like I jotted. In previous slide you have seen that to interpret the definition, I put it in 4 parts. I divided it in 4 parts, number 1, number 2. It's not in the text. This is I have done it in 4 parts. So we also need to divide the entire tender, entire contract in different parts, jot down and then find out what exactly it says, and accordingly we need to proceed for the accounting. Now, the problem will come up. When we go for the construction contract, as I said, you will find that at many places, there is a very fine line of difference where you will find that whether you are entering into Ind AS 18 or it is Ind AS 11, whether it is a revenue or it is a construction contract. Since there is a separate accounting standard or Ind AS, we need to, if it is bridging into Ind AS 11, 18, we need to account for as Ind AS 18 only. Now, whether construction of an asset and specifically negotiated. If this is a building, I negotiated with the owner for construction as per their design, then definitely it is a construction contract. The definition we have already dealt with. Now the difference between Ind AS 18 and Ind AS 11. A specifying major structural element. The owner will give everything. What is the design, what will be the technology, what kind of material will be used. In case of Ind AS 18, limited ability to influence the design. If I had developed a software totally based on the owner's or the buyer's choice, everything he has given, then it is a construction contract, it is not a Ind AS 18. Ind AS 11 or Ind AS 18, by analogy. Now, you need to answer. Entity A develops and sells tailored computer hardware. Tailored. Assume that development makes definition of construction contract of Ind AS 11. As per choice, your choice. You are the buyer, your choice. Entity A also sells software. It's a tally software. Let us presume it's a tally software. To run on computers it develops. Software comprises a 2-year license and after sales support for 2 years. Computer has been developed as per your specification. 100%. The computer which I have developed for Ashokji cannot be used by Shivji. Then whether it should be treated as under Ind AS 18 or Ind AS 11. Whereas software is tally software. It's a on-the-shelf software. So tell me, without looking at the slide, because the answer is given there, hardware, how you will account for? Software, how you will account for?
Hardware AS 18.
Hardware AS 18, wrong. Hardware and software?
Software 18.
Software 18. Because software, I have not used anything. I have given from the cell, I have given you the product. So it's a product. If it is a product, revenue will attract. If revenue attracts, it is. If I have made the software, made the product of your choice, 100% your choice, the other cannot use. Customer made, customer choice, then it is 11. Like building construction, it is your choice. Land may be yours, but your choice. So it is, if I develop real estate, I sell you one property, one block to you, whether it is 18 or 16? 18. Any adverse view or any other view? 18. Everybody at 18. No 16. No 11. Yes, it is 18. But there is a different guidance note. Now the institute has come out with guidance note also for real estate trust. No, but as a buyer, for buyer it is 18. But otherwise also, most of the 18 provisions will be applicable in case of the guidance note also. Now one example. Company working only on one contract it will span for 3 years. The cost, total cost incurred is 1655, rupees 1655. Over 3 years, the contract value, that is my revenue at the end of the 3 years will be 2 million. So 2000 rupees, say 2000 rupees. In installment over 3 years, how should I account for? This is a difficulty, that's why the accounting standard, be it Indian accounting standard or be it normal accounting standard, is required for accounting for the construction contract. Any idea? Percentage of completion. Other idea? Whether percentage of completion method is easy, whether only one way of percentage of completion method, or there are many methods of calculating percentage of completion. Friends, yes. Now we need to look at whether it is fixed price contract or it is a cost plus contract. The moment we come to here, we find that, what is this? It is cost plus or fixed price? Fixed price. Everybody is unanimous. So say, I am very effective. Fixed price contract. If it is a fixed price contract, then we will look at how to allocate the expenditure. Write this in my CUC. Now, this is standard allow only stage of completion or percentage of completion. It is called stage of completion or percentage of completion method. That means how much of the work has been completed. Based on that, you need to allocate what? Revenue or cost? Cost. Both. Our accounting is based on matching concept, husband and wife. It cannot be only husband. It cannot be only wife. Sorry, those who are bachelor here, for them also they will get married one day. But it's a matching concept. Accounting has to be matching. But sometimes we find that as a conservative, that if loss is there, we allow loss to go first. So here, let us see what is the answer. Normally, our traditional or conservative way say that, fine, third year, you account for 1655 minus 2000, so 300 something rupees. You take revenue as well as loss or profit in the third year, and every year you keep it as capital work in progress. But no, our accounting standard or India says that it has to be spread over 3 years. So, in first year, how much? The first year cost is 520. How to calculate percentage of completion? Cost of this year or cumulative cost of this year or all this year divided by total cost, not revenue, total cost. 520 divided by 1655, that is the percentage of completion. So revenue will be 2000 into that percent, that will be revenue. Cost will be 2000, 1655, the revenue balance will be profit and the others will be carry on.
Total cost will be estimated cost.
And I will come to that. As I said in the beginning, in opening remarks, the 5 major points, and one I said that judgment and estimation. So as per India's 8, judgment and estimation has to be done, and it has to be evaluated every end of the reporting period. So 31st March, if our reporting period is there, or if the government will and it becomes 31st December, at the reporting date, we need to evaluate whether the estimation is correct or not. If it is not correct, we need to revise it, and it will not be change of accounting policy. Yes, Premji.
Just wanted to know, is there any minimum percentage that has to be completed before we recognize the expenditure?
That I will come later on. Though this standard does not say specifically, but yes, we need to look at the minimum percent. Whereas in ICDS or others, you must have seen that 20-25% was there. But here we just go by principle based. Everything is not rule based. You decide. That means what is the minimum threshold where you find that you are comfortable. So you are given leeway. Whatever you want, you can do and you can go. And everything has to be on a contract to contract. It's not that if you have 5 contracts, we will accumulate the cost and revenue of 5 and then we'll decide. Contract. Every individual has got his own identity. If there are 100 people sitting here, all are different. So everything has to be accounted for differently. Now revenue. Revenue shall comprise of what items? What are the items? This is normal for class, maybe class 12 or class 14, but still we need to refresh our memory. Revenue will comprise initially agreed amount. Fine, 2,000 million or 2 million. Then amount on account of variations. What can be variation? Incentive. Like Maharashtra government said, if you complete the flyover in 2 months, instead of 3 months, you'll get an incentive of 5% or 10%. Penalty both from client side, from my side. If I delay, there will be penalty. Cost escalation or any other fee. That will be variation. So my initially agreed plus variation, claims made, incentive claim. Provided it is probable. So again, since we are doing on estimation basis, probable and reliably measured. So even if you go for the India 16 plant property and equipment, you go for the research and development India 38, there also we find that in research phase we all space, but when it comes to development phase, then only we start recognizing everywhere. If it is asset, it has to be on identified, reliably measured, and then probable. The standard provides the contract revenue to be measured at fair value. Now, India, virtually everything is fair value except your investment property, India 40, where IFRS allows you fair value, but India still says that in India only cost, no fair value. May have to be revised on account of uncertainties. Every reporting period, end of the reporting period, our estimation, our judgment has to be revised, which will not be treated as change in accounting policy under India's 8, but as a estimation change. Now contract cost. We talked about revenue. We are only jotting down what can be the revenue, but what can be the cost? The cost can be of 3 types. I mean, 3 basic category we have divided the cost. Not we, the IASB. And we have conversed. Specific to contract, general cost which can be allocated. And third is specifically charged, which is there in the agreement, that if it happens on contingency or if you incentive, etc., that is called specifically charged. So the cost is divided into 3 buckets, and the 3 buckets has to be added together to reach at the final cost. The contract cost must relate to a period from the date of starting of the project till date of conclusion over the period of the contract, if it is 3 years, 4 years, 5 years, and whether the question will come up, the contract, the cost will include interest or not, borrowing cost. It will include interest or not. We'll deliberate. Again, when we proceed, I will find that question also will be addressed. I'm trying to address. I have requested CUG not to ask many questions, but I am trying to address all his questions because I know him now. So the interest cost will also be there if interest cost is there. Costs that relate to future activity on the contract, such as cost of material delivered to the site, the advance payment made. This is advance payment. This is my asset. It cannot be cost. Material which is there in the site, not used, it cannot be cost. It is my inventory or what or stock yet to be used. So this has to be. This is normal accounting treatment. But still, since it was there in the standard, I thought I will put it. What should not be included in the cost. Now this is the bucket 1. Direct to the contract. What can be? Labor, site material, vehicle moving there, depreciation of the vehicle, if any charges paid to bring the asset to the site, that charges, direct service cost, I mean design cost, the architect cost, all those which are directly related, depreciation of the plant and equipment which is being used there, mobilization, claims from third parties, this is all direct cost which you can direct put in the asset. Now bucket 1 is over. But if there is any scrap material which is not directly related to the contract, if that is sold and income is there, it has to be reduced. It has to be reduced. Now let us come to second bucket. Cost which can be allocatable, chargeable on the project or on the contract. Is specifically charged.
The third bucket.
Sorry, it is in hurry. Which can be allocated. It is not directly related, but it can be allocated. My plant site, some cost which I can allocate on there and some on my head office expenses. Professional indemnity insurance of the labor, etc., working there, or my office staff also working there. Payroll preparation, payroll for the site, not for my head office. Design and technical assistance that are not direct, but which can be directly attributable to the contract. And it has to be allocated on all Indias. You will find that on systematic, rational, and on consistent basis. Whatever system you adopt, say, what can be the system? Straight line method or based on some other method, but it has to be consistent. Third bucket, cost for which in the agreement, in the contract itself they are put in. General administration cost. So KG6 machine, they say that fine, 5% of your head office expenses you can charge to KG6 machine. That is third bucket. Development cost, reimbursement, but all agreed cost by the owner or contractee. Now, coming to we talked what is cost, what is revenue. Now the main point we have come up, in India or in accounting we know that the things are recognition, measurement, presentation and disclosure. So now we are coming to the main point. Before that we are just going round, but without going round and round, we cannot address the issues. Recognition. So when we go for recognition of cost and revenue, then comes the method, whether it is a fixed cost or it's a cost plus, whether chargeable basis, whether it is a percentage of completion method or some other method. If percentage of completion method is there, then out of three some method they are allowed, which of the method need to be used? Recognition of revenue and cost. It can be recognized, as I said, if it is probable, if it is identifiable, if it is measurable. Measurable means not measuring. Measurable means when it can be measured. When outcome of a construction contract can be estimated reliably. How much cost I have spent, if that cannot be measured, then it cannot be accounted for. The contract revenue, contract cost must be recognized with reference to stage of completion. There is no other method allowed. Only stage of completion method. The second name of stage of completion is percentage of completion method. Outcome of the construction contract can be estimated reliably if, as I said, there can be two kinds of contracts, fixed price and cost plus. In case of fixed price contract, you will find that there are 4 items that need to be kept in mind. Total revenue can be measured if it is a fixed price contract. It is proven on that. Economic benefit that will flow to the entity is known everywhere. That day Bina was also talking about the economic benefit. India 1 or India 16. Contract cost to complete. What further amount is required to complete the project, that is known and can be measured reliably, and the contract cost attributable to the contract can be clearly identified and measured reliably, and it can be compared with the estimates. That is the fixed price contract. So 4 sub-items are there in fixed price contract, whereas in cost plus contract only two sub-items. It is probable that economic benefits associated with the contract can be estimated reliably, and cost attributable to the contract, whether specifically reimbursable, can be identified and measured reliably. If items, fixed price 4 items out of 4 items, and cost plus 2 items. If it test pass, then we will proceed further. Otherwise, we will stop. Now, if it passes, then we will come to that. Yes, that means it needs accounting of cost as well as revenue. Now comes what method? As Suji said, only one method, stage of completion. Fine, but there are again 3 buckets. In stage of completion method or percentage of completion method, the contract revenue and contract cost of the stage of completion are matched with the matching, so that only revenue, expenses and profit and loss attributable to the proportion of work completed is recognized. Number 2, contract revenue is recognized as revenue in the reporting period in which the contract carried out. Contract costs are recognized as expense in the reporting period, and cost incurred relate to future activity must be considered as an asset. As I said, which are the amount which cannot be debited to cost. Stock lying at the site cannot be. So that has to be treated as an asset. So stage of completion, there are 3 buckets, sub-buckets. Cost to cost method, where the cost incurred till date to divided by total cost to complete the project, including the cost incurred. And generally, the first one is used in practice. The second is survey work. We took a value certificate, that how much of the work is completed, which is generally done in case of the government contracts, because there they want certificate, and certificate you can manipulate also. Third, completion of physical proportion. From your naked eye you can see how much of the physical work, proportion of the work is completed. So we will focus more on first sub bucket, cost incurred to total cost to be incurred. Now there can be 3 situations. Cost can be measured reliably, cost cannot be measured reliably, and third is when we find that cost is exceeding the revenue, then what to do with the loss, whether in this year or also in proportion basis over the period. Situation 1, when cost can be measured reliably, then we will use the stage of completion or percentage of completion method. Now the question is for you, all of you. Probably I am disturbing this. Commencement date January 2012. Our reporting period will be, this is taken from foreign country. So reporting period is December 2012. Completion in 13. So 2-year project. It's a 2-year project. Contract price 30 lakhs. Cost to date 10 lakh. In cost to cost completion method, we need total cost also. Cost incurred and total cost. So the cost incurred is 1 lakh, 10 lakh. Total cost is 20 lakhs. So the percentage is 10 divided by 20 is equal to 50%. So as per stage of completion, 50% work is complete. Now, based on that, we will proceed to allocate the revenue, the cost and profit. If revenue and cost is allocated, profit will also automatically come in. See, revenue 30 lakh was the contract